If silver is only $5 away from $100, then the next move could change the entire precious metals market. But there is something even more important than the number itself. The real question is what happens when silver reaches that psychological barrier? Does it explode higher? Does it crash after a huge rally? Or does $100 become the new floor for a completely different silver market? Today we are breaking down the COMEX silver setup. We are looking at supply. We are looking at industrial demand. We are looking at the Federal Reserve. We are watching the US dollar. We are watching inflation. And most importantly, we are looking at what could happen if silver finally takes out $100. Before we go deeper, we need to make one important clarification. The latest market data available on August 12th shows silver trading around the mid-$60 area rather than $5 below $100. Silver recently pushed above $66 before pulling back as traders waited for fresh U.S. inflation data. The $100 level is still one of the most important psychological targets in the silver market. So the central question for this video is not simply whether silver can touch $100. The bigger question is what kind of market could develop if silver moves back toward that level. Silver has already shown the world that it can move with incredible speed. The 2026 silver market has experienced extreme volatility. The Silver Institute reported that silver reached extraordinary highs early in the year before entering a major correction. The data also shows how dramatically the market expanded compared with previous years. That history matters because silver does not move like gold. Silver has a smaller market. It has heavy industrial demand. It also has strong investment demand. When these forces move in the same direction, the result can be explosive. This is why COMEX matters so much. COMEX silver futures are one of the major places where price discovery happens. Traders use futures contracts to express views on future silver prices. Large institutions use the market for hedging. Producers use it to manage risk. Industrial users can use it to manage future costs. Speculators can use it to trade price movements. This creates a market where paper positioning can influence short-term price action, even when the physical silver market is moving for different reasons. That distinction is extremely important. A silver futures price can move quickly because traders are changing positions. Physical silver can remain tight even while futures prices fall. The opposite can also happen. Futures can rise sharply while physical demand is still catching up. This is why smart silver investors should never watch only the headline price. They need to watch the structure underneath it. One of the biggest forces underneath silver is industrial demand. Silver is not only a precious metal, it is also an industrial material. It is used in electronics. It is used in electrical systems. It is used in solar technology. It is used in advanced manufacturing. It is used in medical applications. It is used in many technologies where conductivity and reliability matter. That creates a unique situation. Gold can rise because investors want protection from monetary risk. Silver can rise for that reason too, but silver can also rise because factories need more of it. That gives silver two engines. The first engine is investment demand. The second engine is industrial demand. When both engines accelerate at the same time, the market can become extremely powerful. This is one reason the $100 level matters. At $70, silver already attracts attention. At $80, more investors begin to notice. At $90, the financial media starts talking about it constantly. But when silver approaches $100, the psychology changes. $100 becomes a headline. It becomes a round number. It becomes a target. It becomes a psychological barrier. And psychological barriers can create unusual trading behavior. Some investors will take profits before the level. Others will buy because they believe a breakout is coming. Short sellers may try to defend the level. Momentum traders may wait for confirmation. Options traders may position for a major move. That creates a battle around the number. The important question is which side has more pressure. If buyers overwhelm sellers, then $100 may not behave like a ceiling. It could behave like a launch pad. This is where the US dollar enters the story. Silver is priced in US dollars around the world. When the dollar weakens, the metal can become more attractive to international buyers. A stronger dollar can create pressure on dollar-priced commodities. This relationship is not perfect. Silver can rise even when the dollar rises. Silver can fall even when the dollar falls. But the dollar remains one of the most important macro forces to watch. The Federal Reserve is even more important. Interest rates influence the opportunity cost of holding metals. When rates are high, investors can earn more from cash and bonds. That can reduce some of the appeal of metals. When markets begin expecting lower rates, the situation can change. Investors start looking at real yields. They start looking at treasury yields. They start looking at the dollar. They start looking at liquidity. They start looking at inflation. And they start asking whether precious metals are entering another major cycle. The Federal Reserve held its policy range at 3.5% to 3.75% in June 2026. The next major scheduled event is the release of the July meeting minutes on August 19th. That date matters because markets are constantly trying to estimate the next move in monetary policy. If inflation remains sticky, then the Fed may have less freedom to cut rates quickly. If inflation cools, then expectations for easier policy could strengthen. If economic growth weakens sharply, then rate cut expectations could rise even faster. Each scenario can affect silver differently. This is why silver investors should not focus on one economic report. They should focus on the direction of the entire macro environment. Inflation is another major piece of this puzzle. Silver has a complicated relationship with inflation. In theory, rising inflation can increase demand for hard assets, but inflation can also force central banks to keep rates higher. That can hurt metals, so inflation itself is not automatically bullish for silver. The real question is what inflation does to monetary policy. If inflation rises while the economy weakens, then the market may begin talking about stagflation. That environment could become extremely interesting for precious metals. Imagine an economy where prices remain elevated while growth slows. Imagine investors losing confidence in traditional financial assets. Imagine central banks becoming more cautious. Imagine governments carrying enormous debt loads. Then add rising demand for physical commodities. That is the kind of environment where silver could attract serious attention. And there is another factor that cannot be ignored. Supply. Silver supply is not something that can instantly respond to higher prices. A large amount of silver is produced as a byproduct of mining for other metals. This means a higher silver price does not always create an immediate flood of new silver production. A silver mine can take years to develop. A new discovery does not become a producing mine overnight. Permitting can take years. Construction can take years. Financing can take years. Infrastructure can take years. This creates a major difference between financial markets and physical supply. A trader can open a futures position in seconds. A mining company cannot create a new mine in seconds. That matters when demand rises rapidly. The Silver Institute has documented the huge expansion in silver prices during the past year and the wide range between silver lows and highs. This volatility is a reminder that silver can experience enormous price movements without moving in a straight line. That is why the path toward $100 could be extremely dangerous for both bulls and bears. A bull market does not mean silver goes higher every day. Silver can fall 10%. It can recover. It can fall again. It can suddenly rally 15%. Then it can pull back. This is normal behavior for a highly volatile commodity. The mistake is assuming that a correction automatically means the bull market is finished. The opposite mistake is assuming every rally must continue forever. Both views can be dangerous. What matters is the underlying trend. Now consider what happens if silver breaks above $90. That could become a major psychological moment. At $90, the market would be approaching the most important round number on the chart. $95 could become even more important. Then comes 100. At that point, the market could experience what traders call price discovery. Price discovery happens when the market enters territory where there is less historical trading resistance. If silver breaks $100 with strong volume and strong physical demand, then the market may begin searching for the next level. That could be 110, it could be 120, it could be even higher. But there is another possibility. Silver could reach $100 and immediately face massive profit-taking. Investors who bought much lower could decide to sell. Mining companies could hedge production. Short sellers could return. Options markets could become extremely active. That could produce a sharp correction, and this is why the number 100 should not be treated as a guaranteed destination. It should be treated as a test. The market must prove that demand is strong enough to absorb supply. This is where physical silver becomes especially important. If prices rise while physical demand remains strong, then the rally has a stronger foundation. If prices rise only because of speculative futures buying, then the move could be more fragile. That does not mean futures markets are bad. They are essential for price discovery and risk management. But investors should understand the difference between financial demand and physical demand. This is also why silver miners deserve attention. When silver prices rise sharply, the economics of mining can change. A miner that produces silver at a relatively stable cost can see a major increase in revenue when the silver price rises. But investors need to remember that mining companies are not the same thing as physical silver. A miner has labor costs, it has energy costs, it has equipment costs, it has political risk, it has operational risk, it has debt, it has management risk. So a rising silver price can help miners enormously, but it does not eliminate those risks. The strongest miners can potentially benefit from higher silver prices. The weakest miners may still struggle. This creates another layer to the silver story. Now think about gold. Gold remains the leader of the precious metals sector. Gold is heavily influenced by central bank buying. It is influenced by real yields. It is influenced by the US dollar. It is influenced by geopolitical uncertainty. Silver often follows gold, but silver can eventually outperform gold when investors begin seeking higher beta exposure to precious metals. That means silver can move much faster than gold in both directions. This is why the gold-silver ratio matters. If gold rises while silver remains weak, the ratio rises. If silver begins outperforming gold, the ratio falls. A falling gold-silver ratio can signal that silver is gaining strength relative to gold. That can be an important confirmation for silver bulls. But there is another major factor: geopolitics. Wars and geopolitical tensions can affect silver through multiple channels. They can increase safe haven demand. They can disrupt supply chains. They can increase energy costs. They can change industrial demand. They can increase government spending. They can affect currencies. They can create uncertainty around global trade. Silver can therefore become both a monetary asset and an industrial risk asset. That combination makes it unusual. Now imagine a scenario where geopolitical tensions rise while central banks become more supportive of easier monetary policy. Imagine the dollar weakens. Imagine real yields fall. Imagine industrial demand stays strong. Imagine physical supply remains constrained. That would create a powerful combination for silver. But now imagine the opposite. Imagine the dollar strengthens. Imagine inflation remains sticky. Imagine the Fed keeps rates high. Imagine industrial demand weakens. Imagine investors take profits. Silver could fall sharply. This is why nobody should treat a $100 silver target as guaranteed. The target is possible. The path is uncertain. The timing is uncertain. And the risk is real. There is also a technical side to this story. Silver traders will watch previous highs. They will watch moving averages. They will watch momentum. They will watch volume. They will watch support levels. They will watch the relationship between price and open interest. If silver rises while open interest expands, it can indicate new money entering the futures market. If silver rises while open interest falls, the move may be driven more by short covering. Neither signal guarantees the next move, but together they can provide useful information. The CME Group describes silver futures as a major tool for accessing the silver market and managing exposure to the metal. This is why COMEX activity remains so important to anyone following the silver price. The next major question is simple. What happens if silver reaches $100? The first thing we should expect is volatility. The second thing we should expect is media attention. The third thing we should expect is investor emotion. And the fourth thing we should expect is a battle between those who believe the move is just beginning and those who believe the market has gone too far. That battle could create some of the largest daily price swings silver has ever seen. But here is what many people miss. The most important event may not be the first move through $100. The most important event may be what happens afterward. If silver breaks $100 and falls back below it quickly, then the breakout may have failed. If silver breaks $100 and holds above it, then the market could be signaling something much more important. It could be signaling that the market has accepted a new price range. That would change the conversation. Investors would stop asking whether silver can reach 100. They would start asking whether 100 is cheap. That psychological shift can be powerful. It happened in other commodities. It happens in stocks. It happens in cryptocurrencies. It can happen in precious metals. But there is one warning that every silver investor needs to remember. Silver is not a guaranteed wealth machine. It can rise dramatically. it can also collapse dramatically. The same leverage that creates huge upside can create huge downside. That is why risk management matters. Do not chase a move simply because the headline says silver is going to $100. Do not assume that a prediction is a promise. Do not assume that historical performance guarantees future performance. Instead, watch the data. Watch the dollar. Watch real yields. Watch the Federal Reserve. Watch inflation. Watch industrial demand. Watch mine supply. Watch physical premiums. Watch futures positioning. Watch the gold-silver ratio. And watch how silver behaves when the market becomes volatile. That is where the real information appears. The latest market backdrop makes this even more interesting. Silver has recently traded around the mid-$60 area after reaching above $66. Traders have been watching U.S. inflation data closely because the result could influence expectations for Federal Reserve policy. This means the market is not simply waiting for a silver-specific catalyst. Silver is being pulled by the entire macro system. That is exactly why this market deserves attention. The story is bigger than one number. The story is bigger than COMEX. The story is bigger than one mining company. The story is bigger than one economic report. Silver sits at the intersection of monetary policy and industrial demand. That makes it one of the most interesting commodities in the world. If the next major move pushes silver toward $100, then the market will face a historic psychological test. If silver fails near that level, the correction could be violent. If silver breaks through with strong demand, then the next phase could be even more dramatic. And if the metal eventually establishes $100 as a new base, then investors may look back at today's prices in a very different way. But remember the most important lesson: do not focus only on the destination. Focus on the forces that can move the market. Focus on supply, focus on demand, focus on liquidity, focus on interest rates, focus on the dollar, focus on inflation, focus on industrial use. Focus on investor psychology. That is how you understand silver. The headline says $100. The real story is whether the global market has enough silver to satisfy the next wave of demand at the prices investors are willing to pay. That is the question we will keep watching here at Silver and Gold Watch. If silver begins another major breakout, then the people who understand these forces early will be better prepared than those who only react after the headline appears. And if silver pulls back again, the same framework will help us understand whether it is a buying opportunity or a warning sign. Nothing is guaranteed, but the setup is fascinating. Silver remains one of the most volatile and strategically important metals in the global commodity market. The road to $100 may not be straight. It may not be easy. It may not happen on the schedule anyone expects. But if the forces underneath the market continue to strengthen, then the $100 question will become impossible to ignore. So now I want to hear from you. Do you believe silver can break $100? Do you think it will reach that level before another major correction? Or do you believe the market needs more time to build a stronger foundation? Leave your silver price target in the comments. If you enjoyed this analysis, then make sure you hit the like button. Subscribe to Silver and Gold Watch for more gold and silver market updates. Turn on notifications so you do not miss the next major COMEX silver alert. The silver market can change quickly, and when it does, you want to understand the move before the headline becomes yesterday's news.